but there will be absolute social unrest if we continue with these unfair practices of picking winners and losers by the government.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. A few days ago, an article appeared in the Financial Times revealing that, quote, last month, the government-sponsored mortgage finance agency Freddie Mac filed a proposal with its regulator, the Federal Housing Finance Agency, to enter into the secondary mortgage market, otherwise known as home equity loans. The article's author, Meredith Whitney, claims that if approved, this could begin to unleash almost $1 trillion into consumers' wallets. By the autumn, it could be on its way to $2 trillion. That would be a tremendous stimulus to the economy, but is it a good idea? Putting aside for a moment concerns of its potential inflationary impact, the global financial crisis was a credit crisis triggered by bad housing loans. Would allowing for the government-sponsored entities like Freddie Mac to unleash a flood of new loans risk repeating the sins of the past? For answers, we're fortunate to turn to mortgage lending expert and housing analyst Melody Wright. Melody kindly made herself available despite being in a location with poor internet connection. But despite some challenges with the video quality, the audio is just fine. And trust me, folks, this is a discussion worth listening to. Melody, thanks so much for joining us today.
Thank you so much for having me, Adam.
Hey, it's such a pleasure. Thank you so much for dropping everything when I called you to ask if you could comment on this new article. You're joining us from a remote location. The connection isn't perfect visually, but hopefully folks can soldier through that. All right, look, lots to talk about, but I know you've been chewing on this recent article. Let's start with the punchline first, if we can. Is this a good thing, a nothing burger, or is this potentially like a colossally bad idea?
The first thing I want to say is that one thing most people don't know is that we've already had equity withdrawal. And so people don't talk about this, but the forbearances that were taken out, the over 8 million people that took those out during COVID, actually the way they resolved that is they put all of those missed payments and a non-interest bearing lien at the back of the loan to be paid off when either they pay off the loan or they sell the property. And so nowhere have you seen in the media talk about these outstanding balances. I've also tried to understand whether the Fed is tracking them, and it does not seem so. And so I just kind of want to say, even before we get started on this conversation, that we've had over 1.5 million borrowers already take some form of equity withdrawal that's not really being tracked. And so, and go ahead.
Well, I was just going to say, just to make sure I and the audience follow, it's mortgage equity withdrawal, not because they went to the bank and said, I want to take out a mortgage equity loan. Because of the forbearance, the bank said, look, you just don't have to pay us for this period of time. And what you would have paid us, we're just going to tack that on to the end of the loan so that when you have to pay it off, you're going to have to pay us that extra stuff that you haven't yet.
That's correct.
Okay.
That's correct. And we're starting to see the first, social media posts about people being very surprised by this when they go to pay off their loan. Now, regulations would have said that they should absolutely get a monthly billing statement that tells them what that combined loan to value is. But servicers' technology is ancient, late 60s, early 70s. Nothing has really changed. And so that would have been very difficult for some servicers to affect. And in fact, the CFPB, or the agency that oversees mortgage, kind of said to the servicers, we're going to give you a little leeway. We know this is hard. Do your best. So we are just now seeing people being surprised by this on social media posts. We're going to start to hear a lot more because everyone thinks that people can walk out tomorrow and sell their home and kind of garner all of this supposed untapped equity.
Okay. So let's see where to start on this journey here. Maybe one, just to make sure we bring the whole audience along. The agency that is making this proposal is Freddie Mac, which is known as a government-sponsored enterprise.
Enterprise.
GSE.
Yes.
Yeah. Can you just maybe define or explain what the GSEs are, what their role is?
Yeah, so the GSEs have been around since the 30s, and you have the GSEs are the government sponsored enterprise, which is Fannie and Freddie, and then you also have FHA and VA programs. FHA, Federal Housing Administration, that was largely used to be geared toward first time home buyers. People kind of knew, first time home buyers, and so those things, a lot of those agencies have been around since the 30s, trying to offer capital and liquidity in the markets to keep that housing engine running, because as we know, housing is anywhere between 12 to 20% of GDP, and so it's very important to keep it going. And so over the years, though, things really changed. So if you go back and you think about 2008 and that crisis, back then we still had a very large private market for mortgages. I think most people might be surprised today that 85% of origination today is government backed, either through Fannie and Freddie, which they call conventional loans, or through Ginnie Mae, and that's FHVA government loans. And so what happened is, where you used to have the private markets coming in doing private label securitizations, that's where, this is what we all understand from the Big Short. They were selling off these loans, bundling them into securities, selling that to investors who wanted that monthly cash flow. And so it was bad, 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 because the big banks were doing it. Well, what's happened since 2008 with the change of the Basel III requirements is that you've basically got the government stepping in. And so FHA has really become government sponsored subprime. And they are the ones driving the lion's share of the capital markets and this origination market, which, as we also know, was fueled by an even greater fire when the Fed started buying those mortgage-backed securities. So it's a very complicated financing structure, but I think most don't realize that the private players only make up about 15% of this market. And I think that's actually higher than what exists, because most people, even when they originate a whole loan, for instance, and these are a lot of complicated terms, but that's a loan that doesn't go into a mortgage-backed security. Those are usually originated through Fannie Freddie, like underwriting and things like that. And so the biggest lesson of all this complicated jargon that I'm saying is that things have radically changed since 2008. And we are basically, housing is completely propped up by these government sponsored enterprises and agencies.
Okay, and I just want to make sure the audience really gets this. So when they were founded, the FHA, the VA, their role was to sort of try to help disadvantaged people get into the housing market, or disadvantaged sectors. So one was first-time home buyers, right, who had, they were having trouble putting together the capital to get into the housing market, and then the VA, which obviously helps veterans. Now you're saying this is sort of mission creep, metastasization, whatever, but now all of a sudden the vast, vast majority of mortgages are now being underwritten by the government here. So it's not dissimilar to sort of what happened in the educational loan market, where, prior to the new millennia, you had private banks doing most of the college loan lending. Now it is almost all the government. And just to put my own editorializing on here, we have, I think lots and lots of examples of when the government gets too involved in a particular industry, it tends to create a lot of distortion, a lot of mispricing, and oftentimes a lot of bad things happen. And of course, if you look at the price of college tuition, it has risen faster than I think almost anything they track in the price inflation database. And I think largely the fact that the government, kind of took it over is a strong reason for that. So it sounds like you're saying a very similar thing that happened in the education loan market is now happening in the mortgage loan market. I was shocked to hear your stat there that only 15% or less of new mortgage origination is coming from private lenders, which presumably means the rest is being provided by the government. So have we basically become a nation of borrowers from the government for our shelter?
Absolutely. And so it's complicated because people say, well, no, Melody, my non-bank is originating this loan. Well, what they do is they originate the loan based on the underwriting standards. So basically, the GSEs or agencies have this automated underwriting system. You originate that loan, you put it through AUS, which is the initials, and it comes back approved. The minute you get that approval, you kind of originate that loan, and then you want to sell it out to the secondary markets. But the biggest buyers out there are Fannie and Freddie, Ginnie. These guys are out there buying up those loans, pulling them up, and then delivering them into to securities to sell off to investors. And so if the government stopped doing that overnight, Adam, we would have no mortgage market. Period. Especially with the banks are hamstrung with Basel III, where those mortgage loans essentially they have to 100% risk weight them. Whereas with a GSC mortgage loan, Fannie Freddie, it's only 50% risk weighted, and it's essentially less if it's done by FHA, VA. So these are so many complicated terms, but hopefully the idea is that if the government stopped buying those mortgage loans tomorrow, we would have no mortgage market. And they've bought and pooled 85% of all mortgage loans in Q3 of 2023.
All right, Melody. So it sounds like what you're saying is for the vast majority of mortgages that you get at the bank, right? You go down to the bank and you get your loan there from the bank. The bank actually holds your mortgage for what, minutes, hours, a day before it flips
Sometimes
them
less.
GSEs?
Yeah, absolutely. I mean, it's minutes. Anybody that's gotten a recent mortgage, so usually when you price it out there in the market, who, and this is where it gets really complicated, Adam, is like, who's going to service it, because this all gets split up into pieces. So what some non-banks do is they retain the right to service loan. And what that means is they get to take your payments every month for a very small fee. And so, believe it or not, the reason why people don't know that the GSEs and FHA, VA own their loans is because they're never named anywhere in the process. And so it's going to be the servicer who's named as the owner. But the GSEs came up with some fancy legal footwork. They actually, that servicer is a beneficial owner. So as a way to kind of hide how much intervention there really has been in the mortgage industry, the agencies all came up with a way to kind of hide their participation. And so, for instance, if I'm going to foreclose an agency loan anywhere outside of, say, Oregon, because they have rules against it, you name the servicer as a foreclosing entity and not the GSEs, even though they own the loan. So it is a wild game that has just gone on steroids since the GFC.
Okay, and you said earlier that because of Basel III, which is basically it's a set of criteria that banks have to abide by in order to prove that they're solvent and banking responsibly. That if the bank itself were to actually make a mortgage loan to you, it has a certain credit standard that it has to hold itself to. But it sounds like the GSEs have a reduced standard. Sounds like, I think I maybe heard you say 50%, but is it roughly, basically the offset of that is that it sounds like it's easier to get a government approved mortgage because they have lower standards. True?
A lower risk weighting for capital. And the standards they control behind the scenes through those underwriting systems. And I can tell you that they have definitely become a little more lax than most people realize due to things like our credit scores have been inflated, and as well as kind of forgetting to look at ability to repay. And more just on the payment amount and whether someone can afford a payment. And so they've tried to streamline these things, and with streamlining them, I think that they've lost a lot of what's needed to really do credit risk profiling. So it's not necessarily that their standards I don't even know what a bank standards would be at this because everybody looks to the GSEs for their standards. But when it comes to looking at capital, the banks, if they hold those loans on their books, they are risk weighted at such a higher degree. It disincentivizes the banks from participating in mortgage.
Right. So presumably those standards are there for the banks so that they don't get in trouble again, like the way they did leading up to the global financial crisis. So rather than say, okay, well, we're defining what a good responsible loan is, and let's let the banks weed out the responsible loans versus the irresponsible loans. The government has increasingly stepped in over that time to say, well, you know what, we're going to help this system just kind of move along, and we're going to, however you want to call it, reduce our standards, reduce our risk weighting, or whatever you called it, so that we can have more transactions here. And now we're at the point where the government basically is 85+% of owning all new loans. So it sounds like, you know, we are, this kind of goes back to my earlier editorialization of the government kind of oftentimes making an industry worse when it gets too involved like this. It is eroding the risk management of the mortgage pool by being this grand enabler, right? You're nodding as I'm saying all this. Okay.
Correct.
Which
Yes, absolutely.
gets me to the point of the article here, which is, hey, the private market isn't doing a lot of home equity loans right now. So if it's not a good idea, if it's not a good, if it's not penciling out right now for the private market, why is it a good idea for the government to step in and say, well, we'll make those loans, right? I mean, doesn't it just, it sort of
But
strikes me as the fact that again, it's just a lowering of standards. It's a lowering of risk management here, and that to me it sounds dangerously close to the precipice we walked that led us to the 2008 financial crisis. But maybe not. What do you think?
oh, absolutely. I mean, it's really a drug addict's last gasp for those fees. I talk about gain on sale being more addictive than crack, and in this leverage game, where honestly every single one of those transactions is just a basis point on a dollar. I mean, it is, but they need that constant movement of the liquidity because otherwise they can't sort of paper over all of their expenses. And honestly, like what they're trying to do here is get the non-banks to participate. The non-banks don't have deposits. So think about United Wholesale Mortgage, Mortgage, these bigger lenders, Freedom Mortgage, they don't have deposits. They're not banks. And so they are not going to have the liquidity to kind of really get heavy into this market without the government agency there providing that liquidity. And so exactly what you were describing, it's going to, kind of loosen the spigot back up. And this is, of course, very attractive in an election year because it seems like a logical solution. Everybody has so much equity, we think. Why not let them tap it? It's very, there was a program back during the GFC called HARP, which is Home Affordable Refinance Program. It's a little similar, but what they're doing is, theoretically, they're talking about the underwriting being a lot more stringent, that you can only have an 80% loan to value, which would be different from HARP, but it's still kind of the same idea. It's like, how can we just kick the can a little bit longer, give the consumer a little more juice? But the problem is, and I shared this on X Twitter today, an article from March 27th of 2008, talking about how these second liens, these home equity mortgages were starting the next credit crunch in the disaster. And essentially what'll happen is if they go delinquent on that second lien, they can foreclose the first lien. So these are not like credit cards where, to me, this is still a secured loan, and it's secured by real property. And it could mean that they absolutely could be foreclosed for non-payment on that second lien.
Got it. So unlike a credit card where they just cut you off and say you can't borrow anymore, here they can come and say, look, we're taking the house.
That's right. That's right.
Okay. Okay. So yeah, okay. So here's where we get into the real heart of it, right? Which is like, what are the risks here? I know that heavily involved during the GFC in dealing with mortgages and helping people whose mortgages were going into default and seeing the human cost of all that. Why should we be concerned about this? What are the biggest things that would keep you up at night should we to do this?
Because I'm already very concerned about the consumer. We have over 11% delinquency rate on FHA right now, which is at and above its pre-pandemic highs. And I'm reading in my client books hardship letters right now for people who absolutely can't. They're losing it. Property taxes, insurance, they can't afford it. And what I saw that so many people, I think, they think about the GFC as 2008, but in reality, delinquency spiked in 2010, 11. That foreclosure crisis prolonged through 2014, and that's really when prime borrowers came under a ton of stress was around, between 2010, 2014, those people who had in 2010 taken out those second liens as rates dropped. We called it the little refi boom of 2010. It did not stop the process. It just gave them a little bit more time. And I've seen on the other end of this, and entire lives be wrecked and future ability to own homes because this destroys your credit and your ability to get credit in the future. And so, I've just seen so much trauma from this, making it easy for people to become over leveraged that I just think this is a terrible idea. And I feel like we're just, not only have we already sort of recreated that situation through these payment deferrals and partial claims that exist, now we're just going to add on top of it. And it'll be a short-term solution for some. Honest to God, I think a lot of Americans that people think this is going to help, they probably already can't qualify, to be honest with you. So when I said it might be in between a nothing burger and a something burger, I do think that this is going to sound good, but what I'm seeing in consumer stress, the people that this would help the most, they're probably already past being able to qualify for this second lane as it is right now.
Okay. Interesting. Okay. So you're saying this would be somewhat difficult to implement as well because the people who would be helped most by it can't even qualify for it right now. I think I heard you make a comment saying that maybe people don't even have as much equity in their homes as we all think they do, or that they think they do because of this forbearance that's gone on.
That's right. That's
Okay.
right.
All right. So let me just ask you this. I know you're more of a mortgage analyst, but how could this not be inflationary? To use Meredith Whitney's numbers, puts a trillion, lets people take 1 trillion loans out by the fall and maybe up to 2 trillion by the end of the year. How would that not be inflationary? Because I would imagine that money would very quickly get spent on real things in the economy.
If we hit those numbers, it would absolutely be inflationary. If the number she's quoting out there were the reality of what would be achieved, it's absolutely inflationary, and it's just going to increase this wealth divide that we continue to see and price out younger Americans.
Right.
This definitely is not going to help our younger Americans.
Well, it sounds like it certainly would help keep the housing market propped up. In fact, it would, give people a lot more money to finally move and upgrade and all that stuff, right? So, it probably would raise prices. So if you're feeling priced out by
Correct.
the affordability levels in housing right now, only going to get worse for you. If you're on the bottom 80% of the socioeconomic world and you don't own all the assets that the wealthy do, you're going to feel 100% of that cost of living increase, but not get too many of the benefits. So yeah, it just seems like, well, maybe on paper, it sounds like it could be a fun thing. It's probably for the vast majority of people not. So you're nodding in agreement with me as I'm saying this. I don't want to criticize her directly, but is Meredith Whitney, who's oftentimes been a outspoken critic of the way things are done on Wall Street. To me, this feels like a little Pollyanna-ish here, the way that she was sort of describing it of, hey, we could stimulate the economy and the government doesn't have to, borrow an extra dollar. It just sounds like there's a lot of risk here, and all the repercussions would likely fall on the consumer. both in the ways that we talked about, but if this thing actually went belly up the way that we thought it would, could you imagine this not just being another bailout palooza?
Yeah, absolutely. And so just to your previous point really quickly, this is nothing but hyper financialization. I mean, this is nothing but like I remember when I was in undergrad taking out student loans because I could not afford to go to school, but the people that I knew, their parents were taking them out so they could play in the stock market. Like, so the people like me or the idiots, the useful idiots that signed on the bottom line, believing in these programs where asset holders understood this was cheap money to go out and play with. And that's really what they did. And so this is nothing but hyper financialization. This is about let's help enrich those asset holders, give them some cheap money to continue spending and propelling. Because as we know, they do spend. I mean, they drive a lot of the economy. And so going to what Meredith Whitney, like I found this very just confusing, Adam. She has been a critic out there, as well as she has a long-term thesis about the amount of inventory that's oncoming with the boomers retiring, and getting rid of their second homes, or and then also not being able to pass these down to your children because they can't afford them. And so she has a very clear inventory thesis that we're going to have an avalanche of inventory. And so what struck me the most about the article, and I think why I was so incensed, and I told you that this was a hard one for me to read and deal with, is that there didn't show both sides. It didn't talk about, hey, this could be a potential solution, but we have to be careful. We have to remember history. We have to remember what happened last time. And if we are going to do this, we need to make sure that there's, guardrails so that the taxpayer doesn't become responsible for the bailout yet again. But there was nothing like that in the article. There were no two sides, and so I'm a little confused, I have to be honest. And I also feel like it was kind of placed in the Financial Times, interesting venue for that article because it got a lot of pushback. The Wall Street Journal did the editorial board but did a big opinion piece against it, and then that's when we saw the Financial Times. And so I do this is if we think that this isn't political, we probably should check ourselves because this is absolutely political. This is absolutely about dangling a carrot, before November because things are looking pretty dire out there.
So I can't disagree. The timing is super suspect. Let's just assume that it gets green lighted the way in which the article was written in hopes, right? Is this something that literally could be enacted swiftly enough so that people could be taking out loans at that scale by September? Or just realistically, is it something, you were talking about the technology that the mortgage lending industry uses is based in the 60s and 70s. Is this a little bit of a pipe dream with that short enough timing?
Well, it'll get enacted. Will it get
Deployed?
operationalized?
Yeah.
That's a different thing. But I have a feeling, just to be real honest with you, they've been working on in the background on something like this for some time because as we kept seeing rates not go down, I kept waiting for that HARP style product. And so I believe they've probably been working on something like this. However, to get it operationalized, that would take a lot more time. But typically what they'll do is they have kind of preferred partners, and so you'll have people that will be able to do it quickly that they'll probably partner with to get some traction out there. But yeah, it could be it's a 60-day comment period. And so the FA, yes, and we could be off to the races.
Okay. And I guess, I'm not saying it is, but if it's being pushed by the incumbent administration as sort of a let's try to get people to feel better about the economy before they go into the voting booths. Maybe all they need is the good news and people's expectations versus
Definitely.
any real deployment. All right. Let's see here. I guess we can wrap this part up. I do want to ask you about your update just on the housing market in general. But as I reflect to the point you raised earlier about 85% plus of mortgages really being owned by the government at this point, at least new mortgages. And in my parallels to the education system, in parallel with all this, right, there's the whole student loan forgiveness, um, whatever you want to call it, campaign fiasco, depending upon your point of view, and seeing how it's getting stuck in the courts. I just want to mention I got a unprompted direct message over X Twitter the other day from a follower who just said, "Hey Adam, data point for you. I have two student loans. They're not huge, but they're not tiny either, and I decided to just pay one off. And not long after I did, I got a note that the other loan was canceled. And I'm kind of feeling like an idiot that I just paid that other one off early. But he said it got canceled, and he said I didn't apply for cancellation. Like I had no clue that this was
Right.
even in the works. But my lender just
Right.
contacted me and said, "Hey, it's been forgiven." So there clearly seems to be some sort of additional stealth forgiving program going on beyond just the things that are held up in the court at the moment. Um, and we're now, it seemed to be in this really weird future world where a large part of our lives are being indebted to the government, and then the government is sort of picking winners and losers, right? And I know one of the
Correct.
issues that people have with the student loan forgiveness is that it's just so arbitrary, right? It's just these people who have loans right now. If you paid your loan off, yesterday, well, too bad, you don't get any of this, right? Or you chose
Right.
not to go to school because you did the math and it wasn't affordable, right? I mean, if you did the quote unquote
Right.
responsible thing. So it just seems like I'm concerned about the trajectory of this future where, you heard about the old company store of eras ago. Now it's the government store. And I'm
That's
just
true.
curious if you have any thoughts about an economy where it is, basically 100% government financed.
Yeah, a lot of thoughts, right? And I think it's very convenient for the government. We don't talk to each other anymore right now, right? Because I think if there were like if we did hear about some of these things, more of us would come out to talk, and not necessarily even with pitchforks. Like we would be showing up at city council meetings. We'd be showing up to our senators and things of that nature. But it's all stealth. It's all like one thing that radically changed during COVID from the mortgage space is back during the GFC when you did a modification of the loan, you had to re-underwrite it. Like you had to see if they qualify, and you still kind of look to see if they qualify on basic math, but you don't do that anymore. The servicers just send the modification out in the mail for the borrower to sign and make their first trial payment. And so there are all kinds of these little secret things that you're talking about. And I wouldn't say that, it's not like nobody knows about it. They're being kept confidential. It's that nobody's talking about it.
Mhm.
And it's too complicated to talk about. And so most of us don't know that it's happening. And I guarantee you, if when you start talking to your neighbor and they tell you, hey, I didn't pay for 18 months, and then I did this, this, and this, and then I rented my house out. I mean, this anger is going to start growing and building. And I believe that we, everybody is kind of, our government's gotten away with it so far because of because of COVID, because of the fear mongering. But I think that that's limited. And I think that people are waking up and they're done. And I think that let's take Starbucks, for instance, right? The
Mhm.
fact that they even are seeing reduced revenue. If the top 20% are spenders, right? Why can't they go to Starbucks? So, this is an example of the top 20% cannot drive our entire economy. And that 80% is much bigger. And the inflationistas out there, what I don't think they understand, I don't think they know a lot of people in the bottom 80%, to be honest with you. Number one. I think they're kind of in bedroom in these communities where they don't really see a lot of this reality. But there will be absolute social unrest if we continue with these unfair practices of picking winners and losers by the government. And so I honestly believe we've gotten to a place that is there to me, the big banks, government, BlackRock, they are essentially almost one institution acting with kind of one mind to the detriment of most of Americans.
All right, Melody, before we leave this topic of the GSEs entering the mortgage space. I just want to get your quick thoughts on this. Is this potentially setting us up for the Big Short 2.0?
Potentially, Adam, if we're not already there. So,
If we're not already
you know,
there. Wow.
yes.
Really, do you think the
Just
existing book of mortgages is that shaky?
Well, so if we talk about the Big Short 2.0 from a mortgage perspective, no, we're not there yet. But I think what's probably happened is that, the discussion we talk about with the lending going from the banks to the non-banks,
Mhm.
I also think that you've had a ton of lending occur in the private note space. And you basically had wealthy investors come in from sovereign wealth funds, and they would see who was maybe delinquent, but because you can go find that information often on public records, or you can pay a service. And then they would approach those people and they would say, hey, we're going to take over your mortgage. So, not an assumption, because it's not an assumable mortgage, but we're going to take over your mortgage. We're going to pay your payments. And then they would go to their investor and say, hey, this is a good deal. And the investors say, okay, here's all the cash. They'd pay off the borrower, do the proper paperwork at that time and pay off the mortgage. And so I think that what's probably happened is we've had a ton of private transactions that nobody really knows about. And we're starting to see them in bankruptcies because, because there was so much all cash lending, 30%, we're seeing it in those bankruptcies first, these properties that don't seem to have, they have questionable histories. And so I think that honestly, we could already be in a Big Short 2.0 situation because of this private space, and that this program would honestly just enhance, like expedite delinquency for your regular borrower. So it might. I still believe we're probably going to see material delinquency in June of next year. But if we do this type of program, it's going to be much worse for the borrowers at the same time that we're going to see prices erode, and they are going to be underwater very quickly.
All right, gosh, two last quick questions related to this then. One is this private lending, this new private lending part of what's going on, is it just completely dark right now? I mean, is there any transparency in here, or is it just this new free-for-all that really no one knows what's going on?
Well, so kind of what you were talking about, like the stealth, aid where a loan gets canceled, nobody even talks to you. It's so all of these different groups report on certain aspects of the market, and so you have Black Knight, for instance, who is now out there as the prime data gatherer for mortgage. Well, they have 80% of all servicing, but they don't tell you which servicers they have. I happen to know they don't have a certain group of specialty servicers, one of which, who actually services this space, they have a 36% delinquency rate right now. And then if you go look at the Fed, they track delinquency for mortgages at commercial banks. Well, we just talked about how lending moved from the commercial banks to the non-banks. And so if you say the Fed represents the commercial banks who have a lot less of these balances than they used to, than the GFC, and then Black Knight who has 80%, but they're not looking at the specialty servicers, then we are missing a huge piece. And so I can't tell you for sure. It's pretty dark to everybody. You'd have to know a whole lot to be able to see the signs, but I'm hoping to go to a conference in Nashville actually at the end of this month and talk to some of these guys. I've been talking to just people that have been doing it, and this is where I'm getting all my intel.
All right, well, I'd love to hear your takeaways when you come back from that conference. Am I correct in thinking that, look, we've had this banking system that has evolved over centuries in this country that has, it's super highly regulated to try to prevent credit crises from happening. I'm assuming this kind of dark private lending new corner, they don't have that history, they don't have those regulations. And so if delinquencies start going up, I mean, we have no idea what conflagration that could ignite.
Exactly. That's exactly right.
All right. And am I correct? You made a couple comments, but am I correct in taking the impression that we are beginning to see delinquencies in home loans increase?
We are. If Black Knight says that they went down this month. I can tell you that I usually track with them very closely, but I did not see that same. I'm seeing delinquency get very sticky. I think one reason they may not show as much delinquency as me is because of the new production kind of overwhelms, that they can push it down with weighted average balances and things like that. But yeah, it's getting sticky. So what happened in my books is this time last year we had some people get caught up from tax and bonus season and not redefault. This year that didn't happen. We had no cures for those delinquencies, and so that means that it's stickier. And we had more of what we call new 30-day delinquencies. Those people that crossed over that 30+ day of delinquency, that's when they sacrifice their credit. They know it's going to be bad. They give up the ghost. We had more of those than I've seen since COVID. So again, Black Knight shows one view, the Fed shows another, but there's still a big piece that's missing if you're just looking at either of those sources.
Okay, but the sources you look at, the trajectory is that things are starting to worsen as measured by
Correct.
increasing delinquency rates. Okay, and then we have the huge
Correct.
question mark of what will that mean for this private lending space?
Exactly. Yep.
I got to pull myself off my soapbox because I could rant with you on that all day long. While I still have you, it would be remiss of me not to get your latest update on just the housing market in general. I think the last time we talked, you had a fair amount of concerns. Since we last talked, I know you've done a few more boots on the ground market visitations. I watched the video that you did from Austin, which was it was pretty sobering in terms of what you found there in terms of abandoned developments and things like that. Don't let me cede your response here, though. What is your current assessment of the state of the housing market?
Yeah, so as you said, I just got back from a big trip out to Texas where I was in Houston, San Antonio, Austin, Dallas. And, you may even hear a change in my tone of voice. And I think that's because, my very first trip was to Austin in February of 2023. And what I came back realizing is that I should have been even more forceful in some of the things that I said. I was really new at all of this. I was just getting, my feet underneath me, still kind of uncertain. But I mean, what's happening in Austin, if people think that it's not happening in their backyard, there are pockets of it. I don't care if you're in the Northeast. I don't care if you're on the West Coast. There will be locations that are somewhat immune, but this is everywhere. And it's not just new homes. And that's really what we tried to emphasize in the videos. Yes, the new home phenomena is massive, especially in the Sunbelt states, but it's also existing homes. And what Austin shows you, and honestly, Adam, you can drive that city, from downtown all across the perimeter and realize that you see more homes for sale are in the process of remodel, are fix and flipping, or vacant than there are occupied. And this is
Wow.
something I've seen replicated across the country. And so, where recently people were talking about Dallas, for instance, and how X community is really hot and this community is really hot. It's like this is all still FOMO because we drove those communities too. And what you think is a remodel, go look at the deed. Go look at who actually owns that house now. Look at who is in the neighborhood because I think what you've seen a lot of realtors, a lot of investors, they bought in these really desire communities. We're in the middle of flipping it, about ready to sell it, and they're running out of money. They're not able to complete it. And so looks can be deceiving. And, the realtor can tell you that there's been 20 offers, but what proof are they going to show you? And so, I think that what concerns me is that we're in the spring season and you can go back during the GFC, prices rose in the GFC during the spring season. I finally got access to all that information. I'm so excited, Adam. I think my listeners are going to be excited too, because when
Good.
you've got the data, you can be dangerous. But yeah, during the GFC, we saw prices rise during, the spring season. June is typically when that is going to stop. But what you're seeing in the existing home market is we're not making it to the highs. And sales are even down from last year, which, from a mortgage perspective, last year was worse than the GFC if you go by count and not by dollars. So, things are really bad. But the narrative out there is, oh, it's FOMO again, multiple offers. I mean, these people are desperate, obviously. That's why we're doing the second link. And so I think that, what I would tell everybody, or my biggest concern, is that people are going to get back on the train. And I can tell you that in the client books that I oversee, the vintages that are in the most trouble are 2021, 2022, and 2023. You do not want to be a 2024 vintage because, there really is, in my opinion, barring any kind of exogenous event, which suddenly brings in productive jobs again, really only one way that this is going. I don't care how much government involvement, they simply will not be able to manage the amount of fraud that was out there and that we're starting to see unravel as well. And that's what this rampant speculation. And so I think a lot of people that are missing the story overall, they're missing the level of fraud. And I think we're going to be completely shocked and surprised by the fraud that is just now starting to kind of creep out from the shadows.
Gosh, all right. So we've got
Sorry.
fraud. No, we've got the fraud that you're warning about. The video before this one on this channel was David Rosenberg, who warned that through his analysis, the official jobs data is over-reporting the payrolls by like 800,000 to 1 million jobs. So there's fraud, as you're saying. There's faulty data on top of that, and then
Ineptitude.
ineptitude, and then it sounds like you're saying the worst vintages right now, the 2021 through 2023, which was basically all the people who got caught up in FOMO, right? Prices are going up, get in
Correct.
now before you get priced out forever, right? So we also have just sort of
Right.
human foibles, human vulnerability playing into the mix here. So that sounds like a pretty bad cocktail in general. So you
Yes.
said Austin is in a world of hurt right now. Now, Austin was one of the hottest markets, so therefore not a huge surprise that maybe it's cooling the fastest here. But real estate is local and every area is going to be a little bit different. But do you feel that in general, Austin is a preview of coming attractions to the rest of the country?
Absolutely. If I hadn't, so, I started in Austin last year and I've been to, a whole bunch more cities and you can see very Austin like behavior in somewhere called, I'll probably even say it wrong, like Unger, North Carolina, small little town outside of Raleigh that has just been taken over by speculators. So it's all over the place. If do new home source and just search your city, you'll see all these new home builds. But again, also be looking out for the existing home neighborhoods where people have come in doing the flipping as well. So Austin is just a preview of what's to come. And I've seen that borne out across the country, in my different trips. So if it's somewhere like even New York City, honestly, they've had a lot of this flipping and fixing and sort of artificial demand because, for instance, in New York, a lot of rent stabilization apartments are being held off market. And so I would just tell you that there's a lot of vested interest in this narrative of low inventory, including the government grift and all of these programs that everybody's standing in line to receive their handouts. So there are everyone out there is actually against the consumer basically. And so I would just say to anyone who's thinking about it, just to do more research to really try to understand how this works and definitely go local into the community where you're looking because the last thing I want to see is a young family go into one of these new build communities and they're the last ones in and there's 50 vacant homes that then get turned into a rental community, for instance, in the coming months. So, which then degrades their equity.
All right. So I think nationally prices have gone or have still went up on a year-over-year basis. And correct me if that's wrong, but if so, if it is right or if it's close to right, where are we then, to your best estimation, in the tipping point where we go from a housing market that's really been hanging in there or doing fine if you talk to certain realtors, to one where it's no longer debate, where people are like, okay, this has got some serious issues.
Yeah. So for existing homes, depending on which, series you use, and I could spend, 20 hours talking about those, we haven't reached back up to the May 22 highs, but we have seen year over year price increases. For the new homes, we got a little bump up in this last series, but again, not to the highs. And we have definitely seen degradation there. But in reality, we know because of the incentives and the buy downs and all of those things that we're not really looking at the true net price when we look at the new homes. But I think that everything's going to hang in there, unless there is some kind of credit event, unless there's some kind of exogenous event, things will hang in there till the election. We will start to see, in my opinion, weakening in probably July and August as that seasonal, we come off those seasonal highs. People will be like, oh, well, but I honestly believe that by then is when you're really going to start to see softening. But certain series like Case Shiller, we're months behind, and so we won't get Case Shiller in time for the election. Put it that way, to show it absolutely will not show a softening market unless Florida really gets cooking here, and we see places like Tennessee and California really join the Florida and Texas party. So I think more like summer is when we'll start to see weakness.
Okay. So I'm guessing your advice to aspiring home buyers right now would be wait, time's on your side, and probably if you can wait until after the election to see what really happens then.
If you can wait, I would honestly, this isn't investment advice, but if you can, I would. And if you can't, I would just encourage to do a ton of research and reach out to me on X Twitter. I can give you some tools to get the best deal out there. And again, it's all dependent on your goals. If you want to be in your house for the next 20 years, that changes. I need to be in my house for the next 3 years, so everybody's really different. But in terms of real estate being an inflation hedge right now, I just encourage you to look at the carrying cost and that because, these houses depreciate. As you and Todd, I heard you guys talking,
Yep.
So really think about these carrying costs and do a net present value calculation and just make sure that it makes sense to you.
Yeah, and just on that point of home as an inflation hedge, I mean, I understand the general argument for it, but there's a lot of costs of home ownership that go up with inflation, right? And everybody's learning that the hard way right now with insurance, right? Oh, house prices go up. Well, the insurance values have to adjust, and people are getting these gargantuan inflation adjustments. Same thing with maintenance, right? I think you and I have talked about this, which is it's gone up so much now that an increasing number of households are saying, yeah, I've had to defer I haven't been able to afford to do it. Right. Yeah. House
Right.
needs a new roof, needs new gutters, has mold, termite, whatever.
Right.
Right. And I just don't have the money to do it.
Right.
You know, you got to realize that it's a mixed bag when you're thinking about it as an inflation hedge.
Right. Your Zestimate does not take into consideration the age of your roof. Your Zestimate is just looking at, oh, you've got 4 bedrooms and 3 baths. I mean, that's it. It's not taking into consideration, it might take the age, but not really. I mean, when I started digging into these technologies, they do crazy comps to come up with those estimates. But so exactly. And I think what we're hearing from realtors right now is as we've seen in this increase in inventory, what they're basically saying is this stuff is in terrible shape. Like we've told people who are trying to list their home, listen, you're going to have to do X, Y, Z. And then all of a sudden, you thought you had 100,000 in equity, you have 25,000, which is a whole different ballgame. And so, because you didn't do those improvements, and I think everybody just thought they've heard the same song and dance for a couple years out there in the media that if they wanted to sell their home, there'd be no problem. They could sell it because there's no inventory. And so they are just absolutely, most people are delusional right now about the value of their home.
Wow. All right.
Sorry.
Well, no. It's just the hard fact. All right. Well, look, Melody, like I said, I called you out of the blue and asked if we could just get you to come on to have this important discussion. Thank you so much for doing that. As always, you totally bring the goods. I'm sure there's a lot of questions about the housing market that I didn't remember to ask you. So I'd love to have you back on soon to do like a full bore housing market update. But you did a great job in the time I gave you here. For folks that would like to follow you in your work, where should they go?
You can reach me the fastest on X Twitter at M3_Melody, Melody. For my Substack, that's M3 Melody Substack, and my YouTube is M3 Melody YouTube.
Awesome. When I edit this, Melody, I'll put the links up on the screen. Folks will also put the links in the description too, so you can go straight there. All right. Well, look, I've got one last question for you, Melody, about been asking a lot of the recent guests on this program to share a big lesson they've learned along the journey of their career so far. And you've certainly had a really important and interesting one working there in the mortgage space and then becoming a housing analyst. Real quick, folks, two things. One, if you've enjoyed this conversation with Melanie, I want to thank her for coming on such short notice. I would love to have her back on again very soon. Let her know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. A lot of things we talked about here, if you're wrestling with them as a homeowner or a potential home buyer, you want, if you as I always do, I highly recommend you get the counsel of a good professional financial advisor for any big life decisions you're making, especially around big assets like housing. If you've got one who's playing a good guide role for you, great, stick with them. But if you don't have one or would like a second opinion from one who does meet that criteria, consider scheduling a consultation with the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. At thoughtfulmoney.com, you can also sign up for my newsletter, which is free to sign up for. But if you want to participate in the new Macro Pass service, of which Melody is a contributor, thank you, Melody, then just upgrade to premium while you're there. Quick note too, this video is coming out on Thursday. The next day, Friday, that the new week's Macro Pass report is going to come out. It's going to be from Danielle DiMartino Booth. It's a really good one. All right, Melody. So wrapping up with you here, what is a big lesson you've learned across the arc of your career so far that you think is worth sharing with the audience?
I think to always be curious and to always learn new things. I think that, one way that I've been able to remain nimble in these challenging times is that, I learn everything I possibly can that's put in front of me. I try to learn how to do new things. It's how I got into technology. I taught myself basically how to be a network administrator when I was young. And I just keep, sort of enhancing those skills because we don't know what's coming tomorrow. And what is and has been is not necessarily what will be. And I personally have just always been of the mind that I should have as many skills as possible for whatever situation we might encounter. We all need to go make bullets, for instance. I'll do better than some because I'm open to learning new things. And we won't be making bullets, but you know what I mean. We having that ability to open yourself to learn new things without being so stressed out. We're so afraid of change. It really does give you a leg up in times like this. And that would be, sort of my advice is to always stay curious and be open to lifelong learning.
It's an absolutely wonderful answer. Well, thanks so much, Melody. Um, Godspeed on your continued chronicling of the unfolding situation there in the housing market. And like I said, I'd love to have you back on again soon to give a full proper update to folks. But it's just been wonderful. Thank you so much for joining us today.
Thank you, Adam.
All right, everybody else, thanks so much for watching.